Hello and welcome to the Weekend Investing Daily Bytes. We're shooting this episode on 27th of April and a remarkable day at the markets. Nifty finally managing to cross 17,800 decisively. It has closed above the previous week's high. Uh, Today was the expiry day also on the monthly expiries. The chart is looking quite good actually, and I would think that unless there is any external shock to the system, I think we are on the way up now, and the next target could easily be 18,150 or 18,200. So with 4 days on the trot, maybe we'll get 1 or 2 days on the side, but it does seem like the continuation of the trend is definitely on, as we see here. On the Nifty Next 50, also very encouraging. We have broken out of this range a little bit today. That should pick up over time, I think, and that will be a good run if we get here. On the Nifty heat map, you can see the Bajaj twins doing well. Infosys, for a change, bounced hard at 1.52%. So very heartening that maybe Infosys has bottomed out. Uh, Reliance gradually inching up at 0.6%, ITC inching up as well, 0.9%, Bharti Airtel, Dr. Reddy's, Bajaj Auto doing well, uh, BPCL up 1.9%. A lot of public sector enterprise stocks yesterday, for instance, Gujarat stocks, based on the new dividend and bonus and split policy announced by Gujarat government, ran up, and so have a lot of other public sector enterprise stocks in hope of good dividend yields, as well as push towards the public sector investments. SBI Life also doing well along with IndusInd Bank. The biggest loser today was HDFC Life and Hindustan Levers. Levers volume in the results were a bit disappointing. So Levers was down, ONGC was down, Axis Bank just after the markets have come out with the results with the one-time set off of the city retail purchase. I think Axis Bank, the details will come out by tomorrow. How are the results? It does seem to be in line, minus that one figure. So sectoral overview, again, real estate stocks doing well, plus 1.5%, 17.5% on the real estate. And I've been constantly saying on my Twitter feed, please don't ignore real estate. Real estate and precious metals both will do very well in coming times, and they're already doing very well in the last couple of years. We are in a era of higher inflation and a rush towards real assets, and asset allocation therefore is very important. This point uh, should be repeated as many times as I can, and I'm trying to do that, but a lot of folks are very averse to the idea of going outside equity, and I think that at some point may not be so such a good idea to have everything into equity. IT stocks recovering at plus 1.1%, autos plus 0.8%, metals, infra, private banks all doing well. Only FMCG because of levers down marginally. So good day, good week so far, a good month also uh, over the last 30 days. Mid cap index, you can see very well, it has broken out very nicely to 31,400. It should chug along to near 32,000 now. Small cap index also doing very well. You can see here that over the last 15 sessions, only 1 or 2 sessions the index has closed below the previous low. Otherwise, it is just going straight up, and this kind of momentum is extremely good. Nifty Bank is also doing very well after having bounced off this support now. Has reached its previous resistance here at 43,000, and it is gradually inching up towards a all-time high. Stock to discuss here today was Raymond's. you can see how the stock has moved from 1100 to almost 1760 today. And only today, near the close, was the news announced that they are selling off their FMCG business to Godrej Consumers, and they will get whatever 2800 crores etc into the company. But the point that I want to make here is that the market momentum knows much ahead of the news outcome what is happening. A lot of people were contemplating last many days, why is Raymond's running, are they selling off some land parcel, are they doing some reorganization, some restructuring, but nobody really knew. And the price has already run up by 60% by the time the news has come out. So the importance of the price movement before everybody gets to know what is happening is very key, and that's what the Bhava Bhagwan Che principle is all about. So today briefly we will talk about some very basic but very important part of our portfolio creation, our asset allocation is essentially the diversification of uh, stocks within our equity portfolio and diversification or asset allocation across different asset classes. So we'll take a small story here. So let's say Bajaj Finance was a hot stock on everybody's watch list, and it went up extraordinarily 8x in 4 years between 2016 and 2020. So everything was going really good, and nobody was getting a real sort of uh, entry point to get into the stock. So a lot of FOMO happening here. Where should I buy this stock? And ultimately you give in and you say, let's just jump in and do whatever, and put in my entire savings of 10 lakhs into it, and I bought it at 4200. And the next month and a half, 6 weeks, stock moves from 4200 to 4900, and I made 1.6 lakhs on my 10 lakhs of investment. And within a short period of time, I'm really happy that I was able to finally catch it within just a few days. And I've allocated everything to this, and now suddenly COVID happens within 2 months, and my stock goes from 5000 rupees, 4900 rupees to 1800. And I'm devastated by this move, and I get fed up, and I having lost so much of my capital, I become so distraught that I liquidate my portfolio, and I swear to myself that I am never coming to the market again. So this is typically what happens with a lot of new investors, a lot of investors who do investing based on hearsay. Because what you would have noticed is that everybody will tell you when what you should be buying. That itself may be right or wrong, that is a separate question. But you will hear from all your friends, all whoever you interact with for your market discussions, buy this, buy this, buy this. Nobody will tell you that the stock is falling now, get out of it. So that is something that it's a human bias, that once we buy something, we get so attached to it that we never want to sell it, at least not in loss. And one thing which is very important, which a lot of at least new investors miss out, is that whatever may be your entry point, let's say in this example it was 4200 rupees was your entry point into this stock. Now the market doesn't owe you anything that 4200 should come, even if it went down to 1800. Yes, it did come back to that price, I think. But I mean, your price is irrelevant. What I'm saying is it is only relevant because you are anchoring yourself to that price, that this is my price, so I must get it. Whether in 1 year or whether in 10 years, I must get this price back. So at 4200, when you bought it, you evaluated in your own way, whatever may have been your methodology, that 4200 is a good price to get in. But at 2400, at 2000, your evaluation of the same stock somehow becomes very biased. So if the stock is coming off, and there are so many, plenty of thousands of stocks which never come back. This example may be a wrong example in terms of stock coming back, but So once you are in and your mind is anchored to that bias that 4200 is my fixed price, so until I get that, I'll spend 5 years in the stock, and the day it is 4201 I will get out of it. So you may do that, it may happen, but you've lost 5 years of opportunity cost of your capital. So there are many issues, and of course all this period you'll be whining, and you'll have an a drag on your on your portfolio, and also a lack of confidence as to how to pick stocks. So you must have your clear thought process, how you're evaluating at each price, how you will evaluate, how when to get in, when to get out, how much to buy, so on and so forth. And of course, regretting that you put all eggs in one basket. And I'm not saying one stock in an equity, that is one example, but all your money into equity is also the same example. If the great depression happened in 1929, the markets didn't recover for a decade. What happens if we have another lost decade like that? Because everybody is assuming that market will keep going up and up every year, and I hope that happens, but that need not be essentially 100% of the case. There may be a nuclear war. There may be a US-China war next year. Who knows? So you need to diversify. You need to put money into other asset classes. You need to make sure that you don't rock the boat because of your overly, bullish attitude towards the market. Yes, it is good to be bullish. It is good to allocate to stocks, but there is something called risk management. And as you grow older, as you will have more family responsibilities, as you will have more goals, you will need to do this. I mean, if you've never thought about it, then maybe these small videos will help you think about it. So diversification is very important. Just to give you a very simple example of what we've talked about, we have 100 rupees. We bought one stock, 10 shares of 10 rupees each. Stock falls by 80%. We lose yeah, we lose sorry. So we have 100 rupees. We buy one share of 10 different stocks, each at 10 rupees. One stock falls by 80%. We lose 8 rupees out of 100. No issues at all. Second one, we buy, 5 shares of two different stocks at 10 rupees each, 50-50 into each of them. One of them falls by 80%. We lose 40%. So while concentration can really give us, that kick up when you get it right, it can also kill you on the way down. So extremely important, have allocation to different asset classes, and within each asset class, as your portfolio grows, have diversification within each asset class also. So this was the small message that I had for today's session. Understand your risk appetite, consult a financial advisor, diversify across debt, real estate, gold, and other asset classes, and have a great, uh, you know, investing journey. You don't have to go like a roller coaster in your investing journey. Let your equity curve be smooth, and you should enjoy that journey going up. So thank you so much for watching. Let me quickly go see if I have any questions. I will try to get them cleared in a few seconds. Okay. A lot of good afternoon and good evenings to all of you. One guest is asking for stock suggestions, so I don't have a ad hoc stock selection that I can offer you, but stocks that are hitting new highs is always a good way of looking at a watch list where action is there. The stock itself is telling you that I'm trying to become a multi-bagger, or I'm trying to go up. So that's how you can at least create a watch list and then look for trade setups amongst those stocks. Amshita Thakur says, in weekend investing, what are the main metrics which you consider to sell the losers? How early? This show us with few examples. So in weekend investing, and there are a lot of videos that we've done on our YouTube channel, if you can find them. So our main criteria for exit is based on price and volume, and the precise formulation is different for each type of the strategy that we run. So there is not one way of doing it. But in my, I think 2 days back, I did a session where I listed a lot of exit policies. So you could look at exit based on a specific percentage drop. You could look at a exit based on, let's say, a drop in RSI below certain level. Any indicator you could use. You could use MACD, stochastics, anything. You could use a price below a certain moving average. You could use a average true range, and or a super trend kind of a indicator. So essentially the indicator is not important, and the precise parameter of that is not important. What is important is that is you stick to it, in a disciplined manner across hundreds of transactions. That is most important, and you remain with the position size on that. Swaraj Engines is another question from Shobit Jain. So Swaraj Engines chart is extremely good, and I think today they've come out with fantastic results. So it does look like it is trying to reprice itself in the market, and that should be a good thing going forward. So I'm out of my time today. Thank you so much for watching, and I'll see you in the next episode very soon. Thank you so much. Bye.